With the U.S. markets now closed for the weekend, we can take a clear look at where BURU Inc., ticker BURU, finished the week. As of the closing bell on Friday, November 7, 2025, the stock ended the session at $0.2804 per share. This was a notable move, a gain of 3.54% on the day, and it closed right at its absolute high for the session. What's more, it did this on massive volume, with nearly 56 million shares changing hands. That's an enormous amount of activity for a stock at this price level, and it capped off a week of intense speculation and volatility. Now, many traders looking at that chart see the surge in volume and the recent string of press releases about defense contracts and strategic acquisitions, and they see a company on the offensive. The expectation, the narrative you'll see heating up on social media forums this weekend, is that BURU is a company in the middle of a brilliant pivot, a microcap transforming itself into a defense tech powerhouse. But the reality is far more complicated, and frankly far more dangerous. This isn't just a strategic pivot, it's an existential gamble. The truth is, the market isn't just trading the company's future, it's trading its survival. What most of the hype ignores is the company's own Form 10-Q filing from earlier this year, a document that painted a picture so grim it's hard to ignore. We're talking about a report that showed $0 in revenue, a complete halt in sales from its original business, and a lease default that led to its inventory and equipment being written down to nothing. The company itself had to state there was substantial doubt about its ability to continue as a going concern. This pivot into defense isn't a choice, it's the only move it had left. So let's establish the common ground. If you're holding BURU or watching it, you're likely aware of the recent news. On October 22nd, the company announced a strategic alliance with Maddox Defense for a joint venture to build military and commercial drones, a deal they project could be worth $100 million in revenue by 2028. Then, on October 31st, it announced the first phase of an acquisition of Orbit SRL, an Italian software company, to build out its operational resilience platform. Just last week, on November 6th, management gave an update on this transformation plan, talking about strengthening the balance sheet and revamping its original blue laser business. This all sounds fantastic. It's a flurry of activity designed to show momentum. But here is the challenge to that narrative. This entire transformation is being funded on the back of a publicly traded shell that had, for all practical purposes, a failed core business. The capital to make these moves is coming from equity, and that means the risk of massive ongoing dilution for existing shareholders is not just a possibility, it's a certainty. This is a company that has to issue new shares to pay its bills and fund its acquisitions, which puts a constant downward pressure on the value of every share you hold. Let's look at the recent trading. This stock is not for the faint of heart. It is the definition of a speculative vehicle. Friday's 55.96 million shares traded is just the latest in a string of hyper-volume days. Go back to early October, and you'll see this stock trade over 1 billion shares in a single session. On October 7th, the stock exploded 86%, and on October 8th, it ran to a high of $0.85 before collapsing. Since that peak, it has been a painful bleed-out, back down to this 25 to 30 cent level. The price is moving almost exclusively on retail sentiment and press release timing. The Maddox drone news on October 22nd gave it a 24% pop. The Orbit acquisition news provided another jolt. Friday's move seems to be a combination of momentum traders sensing a bottom and optimism from the November 6th transformation update. But the volume is a double-edged sword. While it shows high interest, it also shows a lack of long-term holders. This is a stock being passed from trader to trader, day trader to day trader, each one hoping to catch the next 20% spike and get out before the inevitable pullback. Institutional ownership is practically non-existent, listed at under 1%. This is a 99% retail-driven stock, which is what makes it so incredibly volatile. This brings us to the elephant in the room, the short interest. The battle between expectation and reality is perfectly captured here. According to the latest data from Fintel, the short interest in BURU is not just high, it's extreme. Over 20.4 million shares are held short, which represents an astonishing 26.84% of the entire float. That means for every 4 shares available to trade, 1 is a bet that the price will go lower. The short thesis is painfully simple. They read the same 10Q report we did. They see a company with zero revenue, a history of losses, a going concern warning, and a reliance on dilutive financing. They're betting that this defense tech pivot is a house of cards, a last-ditch effort to pump the stock before it collapses to zero. They see the recent acquisitions and press releases as nothing more than noise designed to attract new investors who will be left holding the bag. What's your take on that 26% short interest? Is it smart money correctly identifying a failing business, or is it a trap for a massive squeeze? The bulls, on the other hand, look at that 26% short interest and see rocket fuel. They believe the shorts are so focused on the failed laser business that they are completely missing the value of the new defense tech assets. They're betting that one of these joint ventures will hit, that a real contract will be announced, and the stock will gap up, forcing all 20 million of those short shares to be bought back, creating a massive short squeeze. This is the narrative you'll find on Reddit and X, the idea that shorts are trapped. But, as always, we have to look at the reality of the data. This is an actionable insight for anyone trading a heavily shorted stock. You must look beyond the short interest percentage and check the days to cover. For BURU, the days to cover is 0.40. That is incredibly low. Because the trading volume is so high, averaging 50 million plus shares, a short seller who wants to exit their position can do so in less than half a trading day. They are not trapped. This isn't a situation like GameStop, where the days to cover was extremely high. Here, the shorts have an easy exit as long as this massive volume continues. A squeeze is much, much harder to orchestrate when the escape hatch is that wide. What is more telling is the off-exchange short volume ratio, which has been consistently over 60%. This means a huge portion of the shorting activity is happening in dark pools, away from the public exchanges. Bulls will point to this as manipulation. Realists see it as large players being able to mask their activity. Another red flag from the data was the massive spike in fails to deliver back in September, where millions of shares failed to be delivered on time. This can be a sign of settlement issues or, as some speculate, naked shorting. So how do you act on this? You have to be a skeptic. You can't just trust the press releases. You can find the short interest data on sites like Fintel or S3 Partners. You need to watch that days to cover number. If trading volume suddenly dries up and that number jumps to 2, 3, or 5 days, the shorts are suddenly in a much more precarious position. You also need to watch the borrow rate. Right now it's around 8%. That's expensive, but it's not the 100+% rate that signals a true panic. If you see that borrow rate spike, you'll know the supply of shares to short is gone and the squeeze might be on. But do not, under any circumstance, mistake a high short interest for a guaranteed win. The shorts have a very strong fundamental case here. To understand the future, we have to quickly understand the past. BURU was a legitimate technology company. It was founded in 2015 to commercialize blue laser technology. This tech is actually important. Its unique wavelength is fantastic for welding copper and other reflective metals, a key need in manufacturing EV batteries, consumer electronics, and 3D printing. The company has a portfolio of over 220 patents. The expectation was that this intellectual property would make it a key supplier. The reality is that it completely failed to commercialize this technology at scale, leading to the financial collapse we saw in early 2025. So, the future outlook is entirely dependent on this transformation plan. The company is, in effect, trying to become a defense tech holding company. But there is a massive catch, and it's buried in the SEC filings. The $12.5 million acquisition of Orbit SRL is a related party transaction. The company is buying Orbit from Vanguard Holdings, which is wholly owned by Alessandro Zamboni. NUBURU's own executive chairman and co-CEO. This is a monumental red flag. The company is using its equity and cash to buy an asset from its own chairman. This raises serious corporate governance questions and forces investors to ask if this deal is truly in the best interest of shareholders, or if it's a way to transfer assets and value to an insider. This is the kind of detail that short sellers feast on. Comment below with your honest take. Is this new defense tech pivot a brilliant move to save the company, or is it a last-ditch effort that will end in more dilution? As we head into the new trading week, NUBURU remains one of the most contentious and speculative stocks on the market. The expectation is that a 0.28 stock with drone deals and defense contracts is a lottery ticket. The reality is that this is a company with a history of failure, zero revenue, a